What's up, traders? One hour exactly before the FOMC. Let's wait for more people to join and we'll start. Okay, USD pairs higher, and then we see. I'm going into the event with small positions. Let's say, to be honest, this is one of the most difficult situations, events, FOMC, call it whatever you want, because Fed it is standing between two boats, as we say. They did the Davis pivot on December, the Fed put, as was called, but inflation remained sticky, and they changed their mind, but they don't gonna admit. That's why I believe Powell is not gonna be as hawkish as he wants. He will keep something behind. I mean, he will try to kick the can using the common data dependent wording, and to be honest, it is one of the times that he will be correct, because it is really data dependent, and I believe that if oil prices cool off further and oil goes back to 60-70 per barrel dollars, there is no other inflation pressures, because everything starts from the oil, okay, everything. But okay, remains to be seen, because economy is in recession. We can see this from the PMIs, that most of them are near 50 or below 50. And the only thing that going higher is the prices, and it's mostly driven from the oil and its products. Anyway, I'm not gonna enter into fundamental analysis. I was never good. I always said that there are thousands of economists with PhDs, and can tell you about numbers and macros better than anyone, but they cannot trade. This is the big advantage that we have as a traders. We press the buttons. This is the most difficult thing, guys. To press the fucking button. You can be the best analyst to describe everything, to analyze the news and blah, and this payrolls means that, and this PMI means blah 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 blah, and prices blah. But you cannot fucking trade. You can be one monk trader, as I like to call it, in one mountain in Tibet, or in one deserted island with a laptop, and just charts and make a ton of money. Anyway. I think this spike higher is a little bit optimistic. What do you believe, guys? Do you have any positions? Which group you are, Alex? Because we have moved to Discord. Are you in the Discord? You are Euro Aussie long. Okay, good. I'm short and this makes a market. DXY will sell off after hitting 170. Oh. So you expect 100 pips dollar higher? We see. I expect initially first move lower for the dollar, and then we see a reversal and spike higher, but remains to be seen. Most of the European markets were closed today, but okay, we saw DAX lower, US markets churning at the lows. Gold also starting to move lower. I was expecting this reaction higher after hitting the support at 85.90. I believe we are gonna see my target at 69, 22.69. Okay, I close stupid music. What else? Nvidia plunging 4.5% lower today. Nvidia follows my path exactly to the pip. I think we are gonna see 600 handle soon. This is big move, okay, this 30% lower. Apple already started the downtrend. We see confirmation also from the moving averages. Something that we don't see in Nvidia yet. Okay, let's check a little bit the yen crosses. I believe they're gonna move only when Bank of Japan intervene again. Crypto is interesting. At the lows, we see some attempts of Sol trading higher after testing 120. BTC, to be honest, I don't like this break lower. It's trading very heavy. And if we cannot enter again above 59, I'm afraid we're gonna have a bigger time of pain and downtrend. Okay, F is dead, but I think they are gonna try to close it above 3K, that psychological number. But in the long term, you know my views for Ethereum. It's a total crap coin doing nothing, no progress, no transactions, not real transactions. I mean, you cannot go buy your coffee paying with Ethereum. You cannot buy anything paying with Ethereum, but because why in the heck, even if the merchant was accepting Ethereum, you would pay $100 or $50 in transaction fees when you can just use your Visa card and pay with zero fees. Also, the ecosystem is dying there for this reason, and all this tokenization moving to Sol. That's why I remain bullish on Sol. To be honest, there is no real applications. The 99.9% of volume in Sol is for buying shitcoins, meme coins, and rug pulled coins. Okay, so, but this is crypto, guys. Don't lie to yourself. We are almost 15 years in this technology, call it, and we cannot fucking have one real market application, guys. All the fucking scam crypto projects doing something. Okay, take the Cardano for example, one of the oldest crap. What the fuck has Cardano done 15 years now? Nothing. Nothing. Pure nothing. They are gonna do that. I have heard in live when he came to Athens, this scammer, the doctor that is, I forgot his name now, the creator of Cardano. He's a doctor in profession, but he's very good salesman. And he was telling the plans for Cardano will this adoption in the banks, in the merchants, in the stores, everywhere, and nothing has been done 10 years now. And we will not be done. Don't lie to yourself. The only thing that is be done in crypto is just pump and dump sims. There is no adoption, there is not gonna be adoption for what? There is nothing that crypto can do better than it is done today. Okay. Why to make your life difficult using crypto? To pay something if at the end you are gonna convert it to dollars to pay. Anyway, it's just a big Ponzi pyramid scheme, and the earlier you go in and you can convince others to join, prices will go up. We can see this in the meme coins that are pure shit. Pure shit. You see the whiff coin, this fucking dog with a hat. With a hat, not with, because they are like autistic. With a hat, dog with hat, cat with hat. What the fuck is with? You fucking autistic kid. Anyway, and it has a valuation of 5 billion, 6 billion, 10 billion. Come on, guys. For nothing. Nothing. It's just one fucking dog with hat. I cannot. Sorry, guys, but it's so fucking hilarious. Okay, I have traded those shitcoins too, and I do because it's money to be made. Okay, if you have if you see the momentum, and there are many stupid people, more stupid than you, that you are buying now, and are willing to buy higher than you, so they are more stupid than you because you are stupid. We are stupid that we are risking our money in these shitcoins. It's all good. Stupidity is at the highest in our society, so. You see, you already paid the phone for with the stupid airdrops. Ah, you bought the Solana phone. Yes, I have been hearing about this Solana phone pre-sale 2-3 years now, and still it's under construction. When is the delivery times for Solana phone? Nobody knows. Anyway, it's good because I have a position in Solana, so let's see this pumping above $200, and I will start taking profits because I see. And mark my word, you are hearing this from the first time. We are gonna see Solana at $20. This area here. After this pump finish, if it comes, but it will come because we see the huge momentum. Solana back to $20. You heard it now from Greg. Okay. What else? Also the fact that everybody and their mother and their father and the father of their father and the mother of their mothers knows that the bull market will come exactly at 3 months after the halving. The new high will come 2.5 months after the halving. Yeah, sure. It's the most certain thing. It has happened 4 times in the past. So hilarious. Okay. Anyway, we have less than 10 minutes until the decision of Unchained hits the wire. So we are leaving the store of value or digital gold aside. And let's go to the DXY dollar. Okay, let's put some fucking music. Who remembers this? Dynasty. Back to the 90s. 80s. I don't remember. This is the better. Also, NQ seems to like this music. Dollar buying ahead of the decision. But I believe it's nothing. Boom, we are gonna see a quick reversal. Less than 2 minutes. Okay, less than 1 minute. We see some volatility. But nothing big. And here we go. I said euro spiking higher. What's happening? Dot plot. Anyone? Dot plot. Okay. I close the long. Come on.
Order filled.
Let me find the dot plot. Fed cutter. Yields falling. My initial scenario, we see dollar falling and then the party will start exactly as I was seeing this. Let me take some profit in euro. All good. I'm covering some dollar shorts in this spike.
Order filled.
Nice. What was that? Okay, cable. I think I was Aussie as well. Yes, I'm in Aussie. Okay, let's take profit in Aussie.
Order filled.
All good. be honest, I can just close the screens and go call it a day with the profit already made. But because we are traders and we like to trade and take the risks, we are gonna try to to fade this move in the dollar lower. By buying, I would like to buy at 106 and below if we see. Come on guys, push it lower. Especially if I see 107, boom. Short, short, short. Yes, we have the dot plot very accurately. What the fuck it says? Let me scrolling my Twitter news feed. Fed hunts benchmark rate, blah blah blah. Lack of further progress towards 2% goal in recent months. Oh. And dollar was falling with this. Okay. Okay. What the fuck? Well, what's going on in crypto? Bitcoin bumping solo. 130. Let me take profit from low buys in Sol. What else?
Incoming mail.
Okay, I will check my mail. Don't worry. Okay, leave the Sol for now. Let's focus on real markets. Almost 107. I believe we are gonna have another attempt to short the fucking euro. What did you trade, guys and girls? Okay. Now we were waiting for JP. 20 boring minutes. Forex Live, USD moves lower, stocks are higher. Thank you for the information. It's a bit boring, but it's nice that we took profits. It's not easy to be profitable in these trading conditions, guys. Let's be honest. So far, so good. Let's see the next big move. I believe yields are gonna reverse higher, meaning that bonds will sell off. And dollar, what dollar does when bonds sell off? Going higher. And what stocks do when dollar goes going higher? Sell off. You see, trading so simple. It's like crypto halving trading. And we are here waiting for JP. And my friends are drinking cocktails and smoking cigars and waiting for me. Okay. Let them wait for 1 hour more. If dollar breaks above 25.30, bye bye. Same for gold. Okay, let's focus on the euro when JP starts talking. Let me find the Fed link. Okay. We are ready. When he starts. Crypto shitcoins starting to pump, I think. Okay. I'm coming back. Okay, 7 minutes to go for Powell on the wires. Okay guys, let's see. Okay, I like to see Euro going higher. Ideally, I would like to see 20, 25, 30 area to go short. Not above, not below. Okay, let's see. Less than 5 minutes to go and we see dollar pushing lower as expected. Let's see how low it will be pushed. Gold, I would like to see 15, 16 for short. I think crypto knows the answer. That's why we don't see pump. They are sniffing the market. Let's see, let's see. DAX also pushing higher. I'm tempted to short. Also, don't forget that tomorrow we have NFP. Okay, not tomorrow, on Friday. be honest, I don't see any level to go short below before 650 if we break above here. Where comes the moving average? The moving average. The moving average. I will start talking like Lagarde now. Fluctuate. At least Powell knows how to speak English. Ooh. Okay.
Order filled.
I'm just playing with the Nasdaq. Scalping. Ta-da-da-da, ta-da-da, ta-da-da-da-da-da.
Order filled.
Order filled. Give me now back. Da-da-da, da-da-da. Now the dome is moving like
Order
crazy.
filled.
I'm just scalping in and out, nothing serious. Don't worry. I'm putting brackets. 3-4 points.
Order filled. Order filled. Order filled. Order filled.
Okay, I stop playing. We have Powell. What is the sound? Okay.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high.
Let's go.
Further progress in bringing it down is not assured, and the path forward is uncertain.
Big sell-off now.
We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace.
Okay.
Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year.
Okay.
However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
Okay, I'm starting to go
We're
short
strongly
in
committed to returning
euro.
inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay.
Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the
Now we see a
report and
pump
the JOLTS report.
in Euro.
That's demand cooling. The same is
I
true
think
of
we are
rates
gonna see
and hiring
2025
rates,
to
which
go
have
short.
essentially normalized. I also look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored.
Are anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Okay.
Thanks for taking our questions, Chair Powell. I wonder, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that
also
the next policy rate move will be a hike.
Nasdaq
I'd say it's
also
unlikely.
Coming to my resistance.
Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too. Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Thank you, Chris Regan.
Someone gives
Associated
him
Press.
1 horse, please.
You mentioned the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So, has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we gain greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, if that inflation is moving sustainably down to 2%. And another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
And could you just follow on the path where you might not cut? Is that, you mentioned there would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly, incoming inflation data would be at the very heart of that decision.
Nick Demrose of the Wall Street Journal. Chair Powell, to what
Pteromeus.
extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard
Sol
to know
power.
that. I think we'll be able to look back, from down the road and look back and
To be honest, I'm
understand
taking
better.
some profits in my
if you
Sol
look at
from morning buys.
let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can continue. I wouldn't give up at this point on further things happening on the supply side. either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either strong either growth or a strong labor market in and of itself.
Okay,
will
guys, I
automatically,
close
create
the
problems with
live.
inflation, because of course it didn't do that
Got to
last
go.
year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but